Targa Resources, Q2 2026. So they beat the consensus adjusted EPS estimate, coming in at $2.81 versus the expected $2.74.
Mm-hmm.
And actual diluted EPS actually hit $3.54.
Right.
But, and this is a crazy part, on the top line, the company completely missed revenue expectations. They posted $4.44 billion against a forecast of $4.84 billion.
Yeah, a huge mess.
Right, a massive $400 million revenue miss. And yet management turned right around and raised their full year 2026 adjusted EBITDA guidance to the very top end of their previously announced range. So that's the $5.7 to $5.9 billion range.
Which is, I mean, it's a bold move right after a top-line miss like that.
Exactly. And the stock, it just completely brushed off the revenue miss. It jumped nearly 4% in pre-market trading to around $269.96 and closed up over 1% near the absolute top of its 52-week range.
Yeah, it didn't even blink.
Okay, so let's unpack this, because if you're looking at a standard stock screener right now, just looking at the raw numbers, you were probably incredibly confused.
Oh, absolutely.
I mean, how does a midstream pipeline company miss its top-line revenue target by nearly $500 million, yet the stock hits the gas and analysts are cheering? By all normal market logic, a revenue miss of that magnitude usually triggers, like, a massive sell-off.
Yeah, no, it looks like this glaring contradiction on paper. But revenue is actually just completely the wrong metric to fixate on here.
Okay, why?
Well, if you want to understand the health of this specific business, you have to look at the mechanics of the midstream sector. For pipeline and processing operators, like Targa, gross revenue fluctuates wildly, and it fluctuates based on the underlying commodity prices of the natural gas and the natural gas liquids that are just flowing through their systems.
Oh, right, so it's tied to the commodity price itself.
Exactly. So if the open market price of natural gas plummets, Targa's top-line revenue plummets right along with it. And that happens even if the physical volume of gas they're moving through their pipes stays, exactly the same.
Ah, okay. Which means analysts and the big institutional investors, they're largely ignoring that top-line revenue number because it's really just a reflection of commodity volatility, not their actual operational success.
Yeah, they strip it out of the equation almost entirely. I mean, the true measure of a midstream company's health is adjusted EBITDA and free cash flow.
Right.
That tells you what the core business is actually generating in hard cash, from the tolls they collect. And on that front, Targa didn't just beat expectations, they just completely dismantled them.
Wait, how big of a beat was it?
Adjusted EBITDA surged 38% year over year.
Wow.
Yeah, 38%. Up to a record $1.603 billion for the quarter alone.
So they are making essentially significantly more profit on significantly less gross revenue.
Basically, yeah.
But that immediately raises a massive question for me, right? Like, how did they actually pull off a 38% surge? To understand this magic trick, we really have to look at the physical pipes in the ground and how Targa's business is split.
Right, the segment breakdown.
Yeah, so Targa operates roughly in two halves. You've got gathering and processing, or G&P, which accounts for about 44% of their operating margin. And then logistics and transportation, or L&T, which brings in the other 56%.
Right. And the physical reality of the Permian Basin right now is what's driving both of those segments to basically just break records across the board.
It's all about West Texas.
Exactly. The engine powering Targa's entire operation is this sort of localized crisis that's currently happening down to the Permian.
Okay, let's dig into that localized crisis, because the numbers coming out of the G&P side are frankly staggering. Targa saw record Permian natural gas inlet volumes of 7.2 billion cubic feet per day.
Yeah, BCF a day. That's huge.
7.2, I mean, it's up 14% year over year. And it's up a massive 450 million cubic feet per day just sequentially from the first quarter. But, and here's a real paradox you need to wrap your head around if you're following this deep dive, this volume record happened despite the fact that natural gas prices at the local Waha hub literally went negative during the quarter.
Yeah, below zero.
Below zero.
This is where the mechanics of drilling in the Permian become absolutely crucial to understand. Most of the producers down there, drilling in the Permian, they are not looking for natural gas.
Right, they want the oil.
Exactly. They are looking for oil. It's all about the oil. But when you drill for oil, natural gas comes out of the wellhead along with it as this unavoidable byproduct.
Right. Associated gas.
Yes. The industry calls it associated gas. Yeah. So these producers want to sell their really lucrative oil, obviously, but they physically cannot produce the oil unless they have somewhere to put the associated natural gas.
And when all the pipelines leaving the Permian Basin are completely full.
Which they frequently are.
Right. that gas just gets trapped locally.
Yeah, exactly. Which creates this massive bottleneck. The supply of local gas just skyrockets. There's nowhere for it to physically go. And so the local price at the Waha hub plummets below zero.
Which is wild to think about. Negative pricing literally means the producers were paying buyers to take the gas off their hands.
Yeah, just so they could keep pumping their valuable oil.
But the bottleneck got so bad this quarter that paying people to take the gas wasn't even enough, right? Like, producers were forced to physically shut in roughly 200 to 400 million cubic feet per day of production behind Targa's systems.
They literally had no choice.
And for anyone not familiar with the operational reality of that, a shut-in means they literally had to turn off the taps at the wellhead. They had to halt their highly profitable oil production simply because there was nowhere left to shove the associated gas.
It's a producer's worst nightmare.
And yet, even with producers shutting down their wells, Targa still posted a 14% volume increase. How?
Well, they posted that increase because Targa is not just some local gathering company trapped in West Texas with the producers.
Oh, right.
They essentially weaponize that localized drop in prices. Targa is the fully integrated, what they call wellhead-to-water midstream player.
Meaning they own the whole chain?
Precisely. They gather the gas at the wellhead, process it, pipe it down to the Gulf Coast, and then load it onto international ships.
Okay, here is where it gets really interesting for you as an investor tracking these numbers. Downstream, on that logistics and transportation side, they posted record natural gas liquid transportation of 1.1 million barrels per day.
Astonishing volumes, honestly.
Yeah, and they also hit a record in fractionation at 1.2 million barrels per day. Now, let's pause there for a second, because 1 million plus barrels of fractionation is a massive logistical undertaking. What is actually happening inside a fractionator at that scale?
So, a fractionator is essentially a giant distillation facility. When raw natural gas is pulled from the ground, it's not ready to use.
Yeah.
It's this messy liquid soup of different hydrocarbons. You can't just, sell it as is.
Right.
So the fractionator takes that liquid soup and uses varying boiling points to separate it into distinct usable commodities.
Like what?
Like ethane for plastics, propane for heating, butane for blending into winter gasoline.
Mm-hmm.
And Targa is processing 1.2 million barrels of this soup every single day. Once they separate those valuable liquids, they export them, which is why they also posted record liquid petroleum gas, or LPG, exports of 14.8 million barrels per month.
That's just an incredible operation. It's like being the only toll bridge out of a city during a massive traffic jam.
That's a great way to look at it.
The desperate producers in the Permian are essentially paying Targa to take their gas away. And then Targa takes that gas, processes it, pipes it across the state, and sells it at a massive premium into the downstream markets or overseas.
Right. And the industry term for that geographic price difference is the basis spread. Targa acquired the gas locally at West Texas Waha prices, which, as we established, were negative.
They got paid to take it.
Exactly. And then they sold it at Gulf Coast or international prices, which were highly positive. Capturing that massive spread resulted in an unexpected $250 million outperformance in marketing optimization gains for the first half of the year.
$250 million.
Yeah. And the vast majority of that windfall landed right here in the second quarter.
Okay, I have to push back here, though. Because look, you hear management constantly touting that over 90% of Targa's operating margin is supposed to be steady fee-based business.
Right.
Like, they collect a predictable toll for moving the product regardless of the commodity price.
Right, the toll road model.
Yeah, and that stability is the entire value proposition for holding a midstream stock in your portfolio. So if you're a long-term retail investor isn't relying on a volatile, highly opportunistic $250 million marketing windfall, isn't that a massive red flag? I mean, it feels like they just got lucky with a localized bottleneck that isn't going to last forever.
Honestly. Management would actually agree with your skepticism there.
Really?
Yeah. During the earnings call, President Jen Neal and CFO Will Byers were remarkably transparent about the nature of this windfall. They explicitly warned analysts that these outsized marketing gains are, highly opportunistic.
Because it's a one-off.
Right. They are not modeling for these spreads to repeat at this same elevated level in the second half of 2026.
Which brings up a really bizarre quirk in their forward guidance, now that I think about it. If they just banked an unexpected $250 million in the first half of the year, you would expect them to blow their full-year guidance completely out of the water, like raise it significantly. But instead, they only raised it to the top end of their existing range.
Yeah, it looks artificially low. But that decision really comes down to the mathematical constraints of how Targa builds its financial models.
How so?
Historically, Targa simply does not include volatile marketing optimization in its baseline guidance. They just leave it out. They only guide based on what they can reasonably predict, which is that 90% fee-based toll road business.
Oh, I see.
Because they are actively excluding a repeat of those massive marketing gains from their models for the next 2 quarters, the second half of the year mathematically looks, well, significantly more conservative than the first half.
Okay, but let's look at the reality on the ground. Because we know the bottleneck is already clearing up, the Waha basis spreads are narrowing, new egress pipelines like the GCX expansion have already come online to, relieve the pressure.
Exactly.
And management themselves confirmed that the 200 to 400 million cubic feet per day of producer shut-ins already came back online and returned to Targa's system back in July.
Right, and this is a perfect illustration of the concept of built-in offsets within Targa's business model.
Built-in offsets.
Yeah, basically, as the opportunistic marketing margins inevitably fade, because like you said, the bottleneck is clearing, the underlying fee-based volume growth rapidly accelerates to fill the gap.
Because the wells are unshutting.
Exactly. The shut-ins return. New wells are connected. Management actually noted that July and August volumes are currently tracking well ahead of expectations, driven by highly profitable producer economics and higher overall crude prices.
Look, I look at those numbers and I really just have to ask, is management simply sandbagging their guidance here to temper expectations?
Sandbagging.
Yeah. Think about the sheer scale of the volume growth we just discussed. Permian volume growth absorbed 450 million cubic feet per day of new gas sequentially. I mean, that is almost 2 entire gas processing plants worth of capacity added to the system in a single 3-month window.
It's massive.
If the underlying fee-based business is growing at that blistering pace and all those shut-in wells have reopened, why is management playing coy about their second-half projections?
Well, it's the textbook definition of an under-promise and over-deliver strategy.
Yeah, fair enough.
When your base business is already generating a 38% year-over-year increase in adjusted EBITDA, there is zero incentive to stretch your forward guidance just to impress the market today.
True, they don't need to stretch.
Right. Management knows they have this massive wave of recovered and new volume headed straight for their system. But they also know that handling a tidal wave of volume like that requires absolutely flawless execution on the infrastructure side.
Which brings us to the core tension of this entire earnings report, and really the most critical element for you as an investor to weigh right now. There is a massive tug-of-war happening between infrastructure spending and returning capital to shareholders.
Always the tug-of-war.
Always. Because to handle this insane volume growth without the system failing, Targa has to build. And building thousands of miles of pipe and giant processing facilities costs literally billions of dollars.
Yeah, and here is where we really get to evaluate management's discipline, because the numbers are just staggering. Targa is currently maintaining a $4.5 billion net growth capital expenditure budget for 2026.
Wow.
And that is on top of an additional $250 million just in routine maintenance capital.
Wait, $4.5 billion in a single year?
A single year.
I look at that number and I immediately see a massive vulnerability. I mean, if commodity prices crash tomorrow, or if global demand softens, they are left holding the bag on a multi-billion-dollar construction tab.
Yeah.
How is management justifying that extreme level of capital spend to their shareholders? What exactly are they buying with $4.5 billion?
They're essentially building the entire next generation of Permian takeaway capacity.
It's all next generation.
Pretty much. They aren't just laying a single pipeline. They are building a massive, interconnected spider web of infrastructure just to handle the sheer volume of gas currently choking the Delaware Basin.
Okay, give me some specifics.
Right now, they have 5 distinct gas processing plants actively under construction.
5.
That includes Copperhead I and II, Yeti I and II, and Roadrunner III.
You have to build 5 massive industrial plants at the exact same time just to keep up with the drilling output.
If you want to maintain your market share, yeah. And if you want to capture the fee-based revenue from that 450 million cubic feet per day of sequential growth we talked about, yes, absolutely.
That's wild.
And we should point out that their execution track record on these mega projects is currently very, very strong. The East Driver plant in the Midland Basin just came online ahead of schedule. The Train 11 fractionator and the Delaware Express pipeline are also now fully operational and, contributing to that bottom line.
But those are just the appetizers, right?
Yeah.
The crown jewels of this current $4.5 billion capital cycle are still a few years out. They have the massive Speedway natural gas liquids pipeline, which is designed to be expandable from 500,000 all the way up to 1 million barrels per day.
Massive scale.
And they are pairing that with a major expansion to their LPG export facility on the water. Both of those mega projects are on track to be operational by the third quarter of 2027.
Right, and here's the truly rare dynamic you're seeing with Targa right now. Usually, a midstream company is trapped in one of two phases.
Okay.
They're either in a heavy capital investment phase, where they have to freeze dividends and pile on massive amounts of debt to fund construction.
Right, the building phase.
Exactly. Or they're in a harvesting phase, where their growth has stagnated, but they can finally shower their investors with cash.
Cash cow mode.
Yeah. But Targa is pulling off a very difficult dual mandate. They're executing both phases simultaneously.
They really are. I mean, despite laying out $4.5 billion for these 5 plants in the Speedway pipeline, they are aggressively returning cash to the shareholders sitting in the passenger seat.
Yeah, big time.
They just increased their quarterly dividend by a massive 25% to $1.25 per share.
Which is huge.
It is. That's $5 annualized, which gives you roughly a 1.9% yield at current stock prices. And on top of that, they repurchased $80 million in stock during the quarter at an average price of $259.93.
And they're doing all of that while maintaining a healthy leverage ratio of 3.4 times. Which, by the way, sits perfectly in the middle of their target 3 to 4 times range.
So they aren't over-leveraged.
Not at all. It's a testament to how much sheer cash the underlying business is generating right now. They are essentially self-funding one of the largest infrastructure build-outs in the country without blowing out their debt profile.
It is undeniably impressive execution. But, and I have to push back on the timeline here, what does this massive dual mandate actually mean for the retail investor looking at the stock today?
The timeline is the tricky part.
Because $4.5 billion is an astronomical amount of money to put on the table. If that Speedway pipeline gets delayed by regulatory hurdles or, I don't know, if global LPG demand from regions like the Middle East or Asia suddenly cools off, doesn't this capital-heavy strategy transform from a growth engine into a serious multi-billion-dollar liability?
You absolutely cannot ignore those risks.
Yeah.
I mean, the primary threat facing Targa right now is pure execution risk.
Right.
Can they actually navigate the supply chains, the labor shortages, and the regulatory environment to get the Speedway pipeline and the export facility online by Q3 2027? And can they do it without suffering massive cost overruns?
Because if they stumble,
that $4.5 billion spend quickly becomes a heavy drag on their free cash flow.
and even though 90% of their margin is fee-based, like we talked about, they still have commodity-linked exposure.
Always.
If a global recession hits, and hydrocarbon demand drops, the physical volumes flowing through their newly built pipes will drop, which immediately pressures their margins.
Yeah, the reality is that this heavy capital expenditure is going to act as an anchor on their free cash flow in the near term. The critical inflection point for the company, that moment where the heavy spending finally stops and the fee-based toll revenues from all these new mega projects begin generating massive unencumbered free cash flow, that's slated for late 2027.
3 years away.
Exactly. So investors buying into the stock today are essentially paying a premium for that 2027 vision and just sort of holding their breath until management actually delivers it.
And hoping that management keeps executing perfectly in the meantime.
Yeah, no pressure.
Right. Because right now, the overarching narrative of this deep dive is a fascinating, almost ironic paradox. I mean, Targa is a company currently generating record profits, including a $250 million marketing windfall off the very infrastructure bottlenecks it is currently spending $4.5 billion to permanently fix.
It really is wild when you frame it like that.
They are absolutely thriving in the chaos of a constrained Permian Basin, using their wellhead-to-water integration to capture those massive geographic price spreads, while their competitors are essentially forced to shut in their wells.
Right, which leaves us with a critical, forward-looking question for anyone evaluating Targa's long-term horizon.
What's that?
Well, if Targa is extracting massive outsized marketing value from these local basin bottlenecks right now, what happens to their margins when their own mega projects like the massive Speedway pipeline and the downstream export expansions finally come online and eliminate those bottlenecks entirely in 2027?
Oh, wow. Will their sheer operational success in building out this critical infrastructure ironically erode the very volatile marketing gains they just profited so heavily from?
Exactly. Are they spending billions to kill their own golden goose?
That is definitely a thought to chew on as we watch this capital cycle play out over the next few years. If you want to keep tracking how midstream giants navigate these massive risks, or, if you just want to make sense of the latest earnings reports before the opening bell, make sure you follow the show. We are doing deep dives into daily earnings coverage to help you stay ahead of the markets. Catch you next time.